Yeah, I'm losing my
The Fed
edge.
has become a very in-fashion trade as recent as last week and really building up this afternoon. We had a news story come out in the last 24 hours about Janet Yellen, former Fed chairperson, who she had some things to say about certain, what was she? She was talking down the uses
crypto.
of Bitcoin
Yeah.
and stuff like that. And so she came out and shifted around the markets. We have the current Fed chairperson, Jerome Powell, coming out and talking about keeping interest rates low, low, low. And what I love about this, Pete, is the traders are coming out and they're trading against all of those talking heads, which we love. And this is something that we saw a couple of weeks ago with different, hedge fund managers and everybody talking about how, this GameStop has to do this, or this cryptocurrency market has to do this. And everybody took to their trading applications and said, well, no, actually, it doesn't have to do that. We're going to voice some opinions in here. It's a little bit of a different battle. But Pete, betting against the Fed is a trade that's been around forever. It's a trade that I can remember my first year out of college. A lot of people at the prop trading firm that I was at the Chicago Board of Trade, we would the most active day of the month would be the Fed. The Fed meeting. Yeah, the Fed meeting and the unemployment numbers, but even more so that Fed meeting, because they'd come out, Pete, and they'd say, this is where we're putting the short-term rate, and this is what we have to say about it. And then the markets would just whip back and forth because you'd have the people who would buy in and say, oh, well, I believe that this dot plot the Fed just came out with is going to actually dictate what happens in rates over the next several weeks and months. But then you have what we're seeing today, Pete, which is people betting against that Fed and actually putting in higher short-term interest rates as they talk about staying at zero for the foreseeable future. This is an age-old trade that honestly I love.
Absolutely. And you know what? And it's funny, there's a whole generation of traders who's never really seen the back and forth of the battle. So I don't know, whatever we call it. But that back and forth, and I love the point you hit on that. The event itself isn't material. In other words, you can't digest whatever's being said and form an opinion off of it. It's the back and forth around that event and the market's assumption moving forward. So, I think if you listen to, if you try to parse those words, we always talk about that. You don't need to read the report or see the report. The market tells you exactly what the report says. The wiggle back and forth you were talking about was the uncertainty over everybody's next assumption. And that's really what it was. And there was a lot of opportunity. We haven't seen that. And we haven't seen that really. I mean, you can argue they jacked rates down to zero really quickly during the pandemic. They went from 175 right back down to zero. And I think 2 rate cuts. It took us a long time to march up there. And what was it? 11, 12, and 13. But there's been, geez, Frankie, almost 12 years, a whole generation of traders who's really never seen the battle take place here. And this is the perfect time to have that discussion.
Absolutely. And before we get in, because I'm actually going to dive into the progression of them hiking rates and then bringing rates down to zero, and then where we're going to go from here and what that battle actually looks like that Pete's talking about. Because it is funny, a lot of people come to interest rate markets and they think, oh, well, the Fed sets the interest rate. And so when they come out and set it, there's one trade and then it's over until the next time they set it. No, what they do is a very small piece of the whole yield curve, which we offer here at the small exchange in futures. And it really, there's a lot of back and forth, like I said, between, are we actually trusting that they're going to stay at zero? Do we think that they could go negative? Do we think that they'll actually be forced into, a lot of people today thinking they'll be forced into eventually hiking that short-term rate? But before diving into all of that, you have to have your tools here, Pete. And we have, just as of yesterday, new futures product, the small 2-year yield. And this is where I want to focus on. Whenever you're trading, with or against the Fed, Pete, your opinion on what the Fed is going to do in the next, few months or the next year or so, I always advocate for going to the short-term rate product because that's really what they dictate. And you'll see as you add more duration, as you go from 2 years to 10 years on to 30 years, what the Fed influences becomes more murky, right? It's similar to people who trade volatility and it's like, oh, there's a big sell-off in the stock market. Volatility in the short term screams higher, right?
Right.
But volatility in the medium and long term doesn't necessarily play along unless they think that that sell-off could continue for months or years.
Right.
Same here with not implied volatility. Same here with interest rates, lending from that implied volatility example, which is if you're trading based off of what the Fed chairperson is saying or that next Fed interest rate announcement, oh, I think they're going to hike, so I want to buy yields here. You really want to go to the short-term product. And right here, you've got a product that has, it's very small at just over $100 in the product size. I don't think you have a futures product in existence currently that is that small. The margin obviously going to be small along with that. And the average day here, just about 15 to 20 bucks in movement per day, small across the board for this small 2-year yield.
Yeah. And you're absolutely right. If you think about, we always say, smalls are great to take the market, take futures out for a spin. But here's a case where you're absolutely right. There doesn't exist a $100 future, and one that actually, you can trade for $50, day trading for 12 and a half bucks at depending the firm you're at, that still gives you, and we talk about this too. You look at stocks sometimes in ETFs, and they'll move 6 cents or 7 cents in a day. So, and the bid offer is 3 cents wide. It's awful. It's very difficult to find a tradable opportunity with so few unique price points of back and forth, and just the travel itself. This is really giving you, for the amount of notional you have and the capital you're putting up, it gives you a nice amount of travel or back and forth. That's really important when you want to test out a new product.
Absolutely. And the last piece before diving into actually using this product is keep in mind that if that 2-year yield is 0.11%, and for all intents and purposes here as an example, if yields were in the short term literally 0%, that S2Y future would just be $0. 0.11% there, that's $1.10. Very easy for you to grasp where rates are and how they compare to, if this product was at $10, that'd be 1% in the 2-year yield. And you could easily say, oh, that's actually too expensive. I want to sell that. I think it would be lower than 1%. Very easy to understand with that pricing convention relative to traditional products. And like we talked about, Pete, this is really the greatest piece of access for short-term interest rates here. And you can see in the last couple of months, everybody's talking about 10-year rates climbing, rates in general climbing, but these short-term rates have actually been held much lower, held very close to zero, because the Fed continues to reiterate, we're keeping everything at zero. We're keeping everything at zero. And they've brought, and here I wanted to rope in all this activity here because small 2-year futures actually at $1.25, Pete, equate almost exactly to where the Fed has that short-term Fed funds rate. So right now, today, with the S2Y futures, you're at that inflection point of, if I buy these 125s in the 2-year, I think that the Fed in the next weeks to months will lift that short-term rate off of zero, or the market will just have to take those rates higher and they'll be forced into hiking. If I sell that 125, Pete, I'm just pretty much betting on them staying at zero or even going possibly negative, because you can see here the process of 2018. They hiked rates, 25 basis points, got all the way up to 2.5%, Pete, which was a pretty high amount there, and then brought them all the way back to zero very quickly in 2020. And so now we're at this inflection point. It creates a very easy and simple trade to bet on going to zero or returning to normal in this short-term rate product.
Yeah, and it's just, it's as simple as that. And I get the questions sometimes, especially with this 2-year. Being this Fed proxy of, again, the Fed always never picks a particular, they don't pick 12 basis points. They always pick a little window. That's why we see this 0 to 25 basis points. They target that range. That's what they call it, is a targeted range. Can it go negative? Absolutely. So what happens to smalls twos? Do they stop trading? No. All the smalls interest rate futures were built to thrive either above the zero bound or below the zero bound, wherever the market wants to trade it. Doesn't mean we're going below zero. I think you hit on it perfectly. Here's an interesting opportunity to say, whether or not we do, there's something unforeseen and the Fed tests uncharted waters of below the zero bound. The twos will still trade. They'll just trade it at negative value. It's as easy as that. It'll be that same yield-based value. So, it's interesting. The March piece was, pandemic, where they just jammed rates right back down 150 basis points in the matter of 2 weeks. I don't remember with as much clarity the 3 cuts in August, September, and October of last year. And what the randomness is, so I love you bringing this up, because if you said, when were the 3 previous cuts, Pete, I couldn't have told you. But when you look at these movements and you think there's some reason around them, I couldn't even venture what the reason was for those 3 cuts. I'm sure there was some chucklehead chatter around these 3 cuts as being preemptive to something. What it was, I have no clue. And it kind of shows you a little bit the disconnect of what the market does versus what these guys do and the reasoning behind it. That's why we never spend too much time trying to figure out, what are these guys really thinking about?
And this is why you and I love the fact that we're actually traders in the market. We're not these talking heads that are like, oh, the Fed chairperson said this, so this is what's going to happen. And a great reflection of that is, I'm going to rope in here. I hope people's heads aren't spinning quite yet, because I'm going to rope in some Eurodollar yields, which is not a U.S. Treasury yield, but it is a good barometer for where interest rates are looking like they're trending in the next couple of years. And what you see here, Pete, is for 2021 and 2022, and that's that, as you can tell, the small 2-year, it's 2 years worth of duration in the U.S. Treasury. And so the duration of all the way to December of 2022, Pete, is kind of right in the wheelhouse of this S2Y product. And you can see that all the way out for the next 2 years, the market is pricing in right around 0%, right where we're sitting right here today. And so once again, that's that inflection point. But what's really intriguing to me, because people will say, well, why is the 10-year above 1%? Why is the 30-year above 2%? You see a huge rise, Pete, in the projection for short-term rates. Once you get out to 2023 and 2024, I mean, this is a really, really steep rise just outside of this 2-year window. And so once again, creates this scenario whereby the Fed is saying we're at 0, okay? But the market is saying, hey, in the near future, in the next couple of years here, this interest rate is going to rise. The short-term rate is going to rise. And I keep getting back to this word, inflection point, Pete, because we're going to see in the next couple of maybe hours, next couple of days and weeks, though, this S2I product either move closer to 0 and the Fed ends up being correct that they will hold those short-term rates at 0, or what the market's projecting, what a lot of traders are doing as of today, buying up these yields, and the Fed will end up being wrong and being forced into, once again, hiking.
And you know what? You and I always anguish a bit over how much do we show here. And the Eurodollar curve, or this, again, this is today's assumption of where these products will trade. And it's just a 90-day interest rate bearing interest instrument, 5 years in the future. 4 years in the future. So it's interesting to see what the market's assumption is today. Is there any implicit guarantee? No, these move around just like everything else. But you talk about, I think this is the perfect slice. And our products, when we look at that too, and that dichotomy between the 2s and 30s of what's normal. And you mentioned that. Are we staying at these levels, or are we going back to quote unquote normal? Well, we all reference normal in different ways, but you and I, as rates traders, believe there is some mean reverting aspect to normal in this overnight rate, as you just showed us with those Fed rates, is even in the short term, closer to between 2 and 2.5%, not 0.22. So you can see the market trying to put some, is it guesstimate or maybe assumption around that normalization 4 years out? I don't know. I have a hard time coming up with strategies 4 days out. The fact that they're pricing them 4 years out, it's very interesting. It It's representation again today of just what the market is. But I think that, in terms of complexity, we want to stay focused on where that short-term rate is now. But this is a great example of what the market assumes normalization is when 4 years down the road.
Absolutely, Pete. And what's really great about this conversation here today, talking about betting against the Fed, and, one side is looking at those dot plots and all of that research into what the Fed has said and what they've projected. Another side, the everyday trader, is looking at, Eurodollar curves, treasury curves, and seeing what they've projected for the future of short-term rates. The best thing about the small exchange here is they've brought to you a product, a small, standard, and simple product, Pete, that lets you say, I agree with the Fed or I disagree with the Fed. And you go straight to the market with a product, Pete, that is margined under $100. It moves, about $20 per day. And it lets you bet on the fall to 0% and potentially negative for short-term rates, or that reversion to normal, 1%, 2% in short-term rates extremely easily.